Hello, everyone, and welcome to Real Estate Right Now. We talk about real estate matters that matter to you. My name is Jay Izzo, and oh man, do we have a great show for you today. We brought him back, Christopher Coy. You know him as Senior Loan Officer with Towne Bank Mortgage, and we figure it's about mid-year. We're almost there. We're almost to mid-year. Probably should get a little mortgage update of what's going on in the mortgage industry because there's always a lot going on in the mortgage industry. It seems that everything is pretty fluid. And since we're in that midst, we thought maybe bring him back, help us understand where we're at and where we may be going in with the mortgage industry. And of course, if you're watching us live, you can always ask questions as well. So, Chris Coy, welcome back.
Good morning. Appreciate you having me.
We were doing a little something different with the hair thing.
A little bit. It got past the manageable point. Now I'm just hiding it.
Right.
So,
I love what you got going on there, man.
So
I do. I love it. Never thought I would. That's a conversation I never thought I would do on this show, actually, to be honest with you. Mortgages. We've been talking about it for years because things, we had 2.5%, 3% mortgages at one point, which was not all that long ago.
Not long, about a year and a half ago.
And then, we've jumped up. We're over 7-ish right now. Where are we? I guess this is the State of the Union. You are in charge of all the mortgages, and if you were to give the State of the Union address on where we're at with mortgages right now, what would be the State of the Union address for mortgages?
Getting closer to the new normal, I guess, is not too far from it. I don't believe the rates are going to be essentially the long-term normal exactly where they are.
Okay.
But I think people are realizing that expecting, 2.5% money, 3% money is a little bit opportunistic, right? You're not going to nail that. And what people are realizing, depending on where they live, what footprint they're in, that the interest rate makes a difference. It makes an impact on your payment. And it can be a couple $100 difference in your payment between, say, a 3 and a 5 or a 3 and a 7. It might be $400 a month, might be $500 a month in the payment. And that's the reason everybody hit the brakes when the rates went up. Who wants to spend an extra, let's say, $500 a month? So people hit the brakes on that. But during that period of time, the thought process is with rates up, and things slowing down a little bit, maybe housing pricing will relax a little bit. Maybe I can get a deal on a house at the better interest rate. The problem with that, particularly in the greater Carolinas, is we've seen roughly 15 to 18% appreciation in our footprint over the last year and a half. And that's during 25-year highs for mortgage interest rates. So all the people that were waiting to save $500 a month, maybe on their payment going up to that next house, that $500,000 house at 10% appreciation a year, that's another $50,000 it's going up. And that's well below what we've seen in the appreciation. So who's stepping over $5,600, $6,000 in savings, or I'm sorry, who's stepping over $80,000 in savings on purchase price to save temporarily, $5,000 or $6,000 in your payment. So during these higher rates, what everybody's been realizing is, wait a minute, these houses just keep going up in price.
Right.
And that's more impactful than the difference in the payment. So there's lots of silly phrases in mortgage about interest rates. And right now, one you hear out there is it drives me nuts hearing this, but you marry the house and you date the rate.
Yeah, we said that on the show about 150 times. Yes, it does sound ridiculous. It does.
So it's not fun signing up for the commitment on that new house.
Right.
With a much bigger payment right now. So your goal as a family, we have, you might have had the next kid coming, needed another bedroom, wanted a nicer backsplash and a little more square footage, whatever it was. When the rates are similar to where you're at on your current home, it might be a couple $100 difference to get the nicer backsplash and the extra bedroom. Right. But right now, that could be $500, $700, $1,000 a month difference for what you're looking for. Now that comes back to, personally being able to justify that. Are people willing to spend an extra $1,000, $2,000 a month on that other house. And why though I said the payment difference might be $400 or $500, why I'm jumping up and saying a lot more now, because you got to look at the situation, particularly in the greater Carolina footprint. You have people that have been in a house for 4 or 5 years.
Right.
And they might have paid $350 for that house. So now they have another kid on the way. They want a little bit more room. They're thinking they need to be in the $550,000, $600,000 range. And now they have a little bit more room. So they start to get in the mindset of switching, selling their home and buying another one. And the great news is when they sell their home, it's going to be around $550,000. So now they have some equity to move towards the other house. And they're really excited about that until they realize that, wait a minute, they're in a $550,000 to $600,000 house because of how they've appreciated over the last couple of years. So now to get that nicer backsplash,
to move up a level,
you're having to go to the $750,000, $800,000 range. So now you have a $350,000 home owner, or their mindset now has to go to $850,000. So their mortgage might be going from $250,000 to $550,000, $600,000. So you have, let's say, a $500, $600 delta in interest alone, just between what they were at, say they were at 3% and now we're at 7%. Now you add a loan amount 2x to it. You went from a $250,000 to a $500,000 loan. Now your payment is $2,000 more a month than you were paying. And that's a family, now you're getting into discretionary fund money. That's vacation money, that's kids, extracurricular money, that's all those unplanned little things that
maybe even diving into the college fund a little bit.
Everybody's coffers run a different depth.
Right.
So, it could be everything, like right off the bat. And, this goes back to first-time home buyers and home buyers in general. People who don't own a house, affordability in general is under pressure. So the people that were looking to get into a $300,000 house 2 or 3 years ago and didn't, it was challenging for them before at a 3% interest rate.
It's really challenging now.
Yeah, 3% interest rate.
Because there's just nothing in that inventory.
That's exactly right. They're all over the place, 15, 20 years
well,
ago.
we've got to be seeing this. I've got to imagine where you have young people who are looking for an entry home, and they could qualify for a certain amount, but there's nothing available at that amount.
That's exactly what it is. There's just very few homes available under, like, I'm jumping right to 500,000, to get a decent new home, 2-3 bedroom, room for some kids, nice neighborhood, decent schools and stuff. Even a townhome, like a 2,200 square foot townhome, it's roughly 500,000 start. So, at that price point, just to give you an idea on metrics right now, with the interest rates roughly 7%, a borrower who makes around $65,000 to $70,000, if they have no other debt, no car payment, no student loans, no credit card debt, no other debt, debt free, that's $250,000. That's about the maximum a person or a family can afford if they have roughly $70,000 in income in this environment with no debt whatsoever.
Find a house at $200,000.
Almost impossible. In addition to that, you just kind of go through that. Where's the down payment money come from? Everything is super, super tight at that price point. So affordability in our area is leaving as a whole, being able to own.
It's further out.
Absolutely.
I mean, if you're living in Raleigh proper, or in what we might call the Raleigh suburb area, even, right? Yeah. And I'm going to include Garner in this. You got to get out past Garner, and you got to get way out there.
Absolutely. So
I mean, this is a tough. I mean, if you work in the Research Triangle Park, right? Which we love the Research Triangle Park, by the way, because we're part of it. And if you don't know what the Research Triangle Park is, by the way, in in North Carolina, Research Triangle Park is made up of 3 cities, basically Raleigh, Durham, and Chapel Hill, for the 3 universities, Duke University, North Carolina State University, and University of North Carolina, Chapel Hill. So, and they supply about a little over 350 corporations, businesses in the area. And so there's a great amount of careers, jobs, and things here in this area. The problem is that if you want to access that, right, the closer you get, the more expensive the homes get, and especially in the cities. So you have to move further away. And we're talking sometimes 40 miles.
Yeah, significant. So here's a neat anomaly that I never see in the media. You very rarely see it in mortgage or finance publications, but the distance from how far someone lives from where they work, I find it interesting to see the price per square foot in the nicest, most convenient areas tends to be the highest, like 5 points.
Yeah.
You pay more per square foot to be right there next to everything. The beauty of that is you don't have to commute. You're literally walking distance to everything.
Right.
It's great. You don't have any commute, and you pay for that through a higher purchase price or a higher payment.
Right.
And it's crazy how the math works. Every time I kind of just do some quick math on it. So you take someone who right in where they want to be, say it's a little too much. They can't make that happen, but you can find that same offering for less money further out, to your point, 20 minutes, 30 minutes, 40 minutes, 50 minutes away. And when I do some quick math on it, it's funny how the commute time, when you take their income and you divide it basically down to hourly or per unit, and you factor in the commute time, I find people pay exactly the same for a house square footage. Whether they're downtown and paid more for the house, or went way out into the outskirts and paid less for it. If you factor in the extra 30 minutes in the morning, 40 minutes in the morning, 40 minutes at night, now you're hour and 20 minutes a day. You're at 7 hours a week.
It's all the same.
It really is. But the differentiator is some people can afford to pay the difference in time.
Right.
And some people can afford to pay the difference via check and payment. So let's say a doctor or someone, a high earner, can live right there and work more hours, and it makes more sense for him to be across the street from where
a block or two away.
That's right. Whereas someone who might have a slightly lower earning and it's more hourly based, they might have the extra time to do that hour in, hour out, and it might work out for them. So every individual pays it in their own way.
That's cool. That's pretty. See, that's good stat stuff right there, man. That's good stat stuff right there. That's cool.
You can tell I'm a dork at heart.
I love it. I love that. I love that dorky number stuff. Okay, first of all, I do. I mean, you got to remember, I got a graduate minor in stats, right? So I'm into the dorky.
You get it. So
I totally get it. So with the mortgage, and with the mortgage rates where they're at right now, I know that people are looking at things of inflation and where inflation is at, and because there's a number of factors that go into changing rates. I know inflation has been the big number, right? We're all feeling that, by the way.
Absolutely.
I mean, you go to the grocery store, you feel inflation. I don't know that that's necessarily the inflation that they're
it is, and it really is. Like, so when you dig into those inflation numbers, most of the time when they're referring to the inflation numbers, they don't remove, or they actually remove food and fuel, which generally are the highest.
They remove it?
Generally, yes. So you have to look.
But that's where we feel it.
Exactly. Like food, we can spend a day on talking about the difference in food.
I read something like 32% increase or something like that?
Yeah, I mean, a gallon of good milk, organic milk, is $8+ a gallon.
Yeah, there was a point there that organic eggs were $10 a dozen.
Yeah.
Okay,
that's getting reasonable now. The eggs are actually starting
$9.99. Okay, I'm a penny away from 10. Okay, is it okay if I call it 10? But $9.99, and now we start seeing it drop low.
So this weekend at Costco or BJ's, 18 of those free range Ben and Jerry eggs or Jerry whatever.
Right. Ben and Jerry,
whatever. Yeah.
Yeah.
That was $7.29 for 18 of those. So
well, that's more reasonable.
But that's going to a bulk club buying,
right, which you have to have a bulk club membership, which we got to pay. Right, you got to do that type of thing. So inflation is part of this process of trying to put pressure on interest rates, whether they go up or down. What are some of the other factors that, I know we've talked about some of them, but what are some of the other factors that go into how we start altering this interest rate, maybe to drop it down a little bit?
So you got to remember, rates didn't go up because of an event that happened. They chose to purposely raise the interbank offering rate, the Fed rate, right? The rate at which the Fed lends banks money, and the rate at which banks lend banks money. So when the Fed's talking about raising rates, it's not actually mortgage rates, it's the Fed interbank offering rate. And that trickles down. Right. So
there's and I think this is a point, one of the points, and that is there is a trickle down effect here. It's not that it's mortgage rates that they're adjusting, it's the general rate that banks borrow money from the government,
which affects essentially the cost
of everything. Affects costs of everything, right? It's a trickle down.
However, this is making sure we have time. Quickly, I want to point to this. I'm a little bit, not conspiracy, but I like the details on stuff. And something that I find very, very frustrating about what the Fed does is the Fed drives their car with a pair of goggles.
Okay.
And instead of having mirrors on the cars, it has little LCD screens. And instead of having gauges to tell him what's going on in the car, it has historical data from 4 months ago. So Jerome Powell is trying to drive the Fed with goggles that are showing him what's in front of him 4 months ago. What the mirrors on the sides of the car tell him, all of the information that the Fed is making
it's in the rearview mirror.
Is significantly in the rearview mirror, not just a little bit in the rearview mirror.
How do you drive that car?
Great question. So I too would like the answer to that. So when the Fed is slowing things down, that's because they didn't want the economy to overheat. And the point of this is to fight inflation, but it's very key. If you go back to 2.5 months ago, Mr. Powell was on 60 Minutes and they interviewed him. And the key thing I really brought back from that was he states flat out, yes, we are raising the rates to counter inflation, to slow inflation. However, he was extremely clear that never in history when this is done before, or even now, are the expectations that prices will reverse and go back to where they were before. He is very clear that prices will not reverse. Home prices are not going back to where they were. The price of everything is where it is.
And with stabilization is really more the case than seeing something drop.
That's right. They're trying to stop the growth of inflation going forward to get even worse than it is. But where we're at now is where we're at now. Like anybody who really feels that you're going to see stuff go back to 5 and 10 year ago prices, that's out the window. That's just not happening. Look at what pet food. I don't even have to get into it. You all know what you're paying for everything.
But I think we believe that's what we believe that we're fine. I think there is this psychological belief and emotional belief that if the Fed does this will go back to the prices that we had. But it's just simply not true. We've pushed it to this level.
Yep.
It's going to stay there.
Yeah.
We're just trying to keep it there.
When they printed the extra money, diluted, made $1 worth less than $1 was the day before. Inflation hit then exactly at the rate it was hitting, the mathematical dilution of the dollar. And it's math.
Well, no, because there was a point there, I think it was right before the Ukrainian war started with Russia. I think inflation was like about 8.9% or something like that. It was a really almost 9%.
Yeah.
It was a high number right before it.
Yep.
And then after it started, after about the first year of it or so, we started to see it come down a little bit. And then now we're down, I think about 3.4% or something like that.
We are, but that's another thing that you have to really go back to your stats and roll up your sleeves if you're going to talk about that number, because that number is not just a number. That is a rolling 12-month average. So now that you know that the inflation number is a rolling 12-month average, look at how that affects what's going on, and why did it go from 9 to 8, 7 to 6 kind of decently fast, and now why is it plateauing off? Because we're averaging out a 3 number with like a number that's a 10th off of it. So everybody that's expecting the inflation numbers to really quickly just snap to 2, do some weighted averages.
It's
like
not gonna happen.
The bottom of this trough,
it's not. It takes longer. The higher it is, it goes a little steeper down. But then as we get lower and lower, then all of a sudden this thing starts flattening out. Length of time takes longer.
Exactly. So you under the bottom of the parabola.
Right.
You get where we're going with that. So you really have to look into the numbers and know from the numbers that the expectations. So the Fed finally said, hey, we're not raising rates anymore.
Right.
And as the word not raising them anymore is coming out of their mouth, 1,000 hands go up in the press gallery. When are you lowering them? How much? Well, hold on. It just took us 18 months to understand that we don't need to raise them anymore. We're going to stay here for a bit and see how this is working. Like, they don't even get a chance to say, okay,
we're going to take a breath here.
So when are you loaning them? How fast? Well, hold on a second. They never said. It's all speculation on how low and how fast. Give it a minute. And so the media, in my mind, is forcing things worse right now, because the media can't just be cool with, we're not raising them anymore. We're going to lower them at some point. They can't be cool with that. They've got to push and say, well, can you lower them this month? The Fed is forced to say, we're reviewing the numbers, and if things continue to work in the right direction, we will be lowering them and let you know when that is. If things don't continue in the right direction, we potentially could have to continue to raise them. So immediately the media takes that and runs with higher rates for longer. No, the Fed never said that.
Right.
They just said, we know we don't need to raise them anymore, and we'll let you know how soon we're going to lower them.
Because it's interesting that you say that, because again, here comes the psychology of how we think, right? We either want things higher and lower. We really have a hard time with things staying the same.
Absolutely.
Actually, which is funny, right? Because we say we don't like change, right? And yet it's staying exactly the same, but we don't like it staying the same. We want to know, because it puts us in a situation where we go, well, I don't know. Which puts you in a situation as a mortgage.
When are the rates going down?
right. Because the obvious question that everybody has out there, and who's watching and listening to the show, is, when are rates going down? Well, actually, they're going to stay here for now. For now, and we don't know how long that might be.
That's exactly right.
But we'll interpret that as, well, rates might go up. Well, potentially. But that's not what they're saying.
Yeah, that's not the conversation. Potentially anything can happen. That's obvious. Realistically, they have in my mind, they're making progress. We're not at 9. We're not at 8. We're not at 7. We're in the low 3s. And I think a lot of people can argue that, are we fumbling over the minutia at this point? Is there any real math that shows 2 point whatever is materially different than 3.2? What about if you had the food and fuel back and it would have taken out? Like, what are we really talking about? You can get lost in those details. And, so just a day or so ago, the numbers come out again, and they're literally 1/10 below expectations. And that was the media's expectations. So the numbers are off 1/10. They came in like 3.4 instead of 3.5, like literally 1/10 off. Where the last time, a month ago, they were 1/10 ahead. So a month ago, the rates went all the way back up, mid 7s, almost 8s, because of the same exact comment. This time we're 1/10 below, and everything's great again. We're absolutely in the margin of error here. Yet everybody's running this way and that way with it.
Well, I think, and we're running out of time here, but I think the thing that I was thinking of as you were talking is it's kind of like coming out of surgery, right? The first thing you want to do, especially if you have to have multiple surgeries, first thing you want to do is you want to stabilize the patient.
That's it. Yeah.
Right. You want to stabilize the patient, right? Is there some improvement? Maybe, but we probably have some other surgery we're going to have to do in the future, right? But I can't do that surgery right now until I stabilize you.
That's exactly it.
And so it's if we thought about it that way, then it makes sense, because you would never take somebody who just came out of surgery, right, and go, well, we should do more surgery right now.
Exactly.
Right.
Exactly.
Right. We should, or worse yet, go, no, we need to, okay, surgery's over. Let's get him out of bed and get him in rehab. That just doesn't work. So
exactly.
Yeah.
Exactly.
So this has been great.
Well, one piece
Sure.
is, so you asked a great question early about affordability getting into homes. Yes, great question, how this is affecting people. What this comes down to is exactly where we got earlier. The rates are higher right now, but depending on where you live in the country, the one thing we can come up with is, wait a minute, during these higher interest rates, home prices have still been increasing.
Right.
There's still a huge lack of numbers, lack of inventory of houses. And a lot of these things, depending on the footprint you're in, really don't change. So particularly in our area, even with the rates up right now, what it comes back to is this thought process. Is there anything in your mind, if you live in this Greater Triangle area, that suggests you will ever see real estate cheaper than it is right now here? And I think most people that understand this footprint and where the growth is coming from and all those things would immediately snap to no on that. So from a home owning perspective, it's not about the rates right now. It's about, got to get in the house that you want to be in.
Right.
You need enough square footage, get into that, and let the appreciation be your bigger play on your investment in your home.
This has been great, man. Thank you.
Appreciate it.
Tell people how to get a hold of you.
I'm Christopher Coy with Towne Bank. You can find me pretty easily on the internet. Search my name and Towne Bank. You can call me directly at 919-306-8895. And if you want to shoot me an email, it's my first initial last name, CCOY @townebank.com, TOWNEBANK.com.
Thank you, Chris. Hey, folks, it's the show. You know what? You had a lot of choices. You chose us. Thank you very much for doing that. Hey, give us a positive review, thumbs up on YouTube too. That would be fantastic. As I say to you all over the world, thank you so much, and ciao, everybody.